Welcome to the weekly update, where I'll go over the action in the market for the week of September 15th through the 19th, and we'll see how things look for the week of September 22nd through the 26th. All right, set a series of all-time highs, not only for the S&P, the Dow, the NASDAQ 100, and even one of the small cap indexes that we follow, the Russell 2000. It set an all-time high. Now there are two indexes that we follow for the small caps. The S&P 600, which still has a ways to go to get back to its all-time high, set back in late 2024, but the Russell 2000 small cap index did, and that's probably the index that most people follow. So, looking pretty good that way. Now, we're still looking a bit vulnerable on the daily side. We're over 10% above. In fact, we're over 11% above the 200-day simple moving average. We get too far above that, we get overextended in the long term. We hit an overbought condition over the last couple of years. That's where we've seen a fairly significant pullback. Just a pullback, not a reversal. We're also dealing with negative seasonality, which we've been watching since the middle of July. Didn't happen in August. So far, it hasn't happened in September. Friday was options expiration, and the week tends to be positive overall during that week. Well, the week after options expiration tends to lean more negative, and we also see historical weak seasonality from now pretty much until the end of September. Is that going to play out? We waited for it in August, never developed. And we're looking at sentiment, which is positive, but not exuberant right now. And that could still lend itself to more upside. You have individual investors, which are still net bearish right now. They haven't joined in on the party. And you have the sentiment gauges that we follow, the ones that I track many times every day and then show in the daily video. It's positive, but not exuberant right now. And so it's almost like if we're going to go up from here, the market needs to make another push up to suck a whole lot of people in, thinking, oh no, I'm going to be left behind. I better get in. And then when that happens, that's about when the party is over. Now, we don't know if it's going to play out that way. What we saw on Friday was the last options expiration on the monthly cycle for the quarter. And then as we finish out the month of September, that's the last month of the quarter, and there could be some real positioning as we go into that. So we're looking positive. And even if we do see a pullback, even 3, 5, 8, up to about 10%, we could even fall a little more than 10%, freak a lot of people out who've been just expecting the market to go up no matter what happens, cause them to doubt that, and then see the smart money coming in and buying after that. Now, this is not any kind of a forecast. Excuse me. It's just working scenarios as to how things can play out from here. All right, so let's go back over this week's session. For the week, we were up 1.22%. We were above average with volume. Now, a lot of that is Friday because it was the last trading day for the September cycle for options. And so that really sees a big, huge increase in volume overall when that day happened. So it's not really a surprise that we were above average with volume on a weekly scale, but most of the days, even when they were rather lethargic and we didn't see a lot of price movement, volume has still been fairly healthy. So you take it in that context, and we're seeing lots of participation here. And we are positive. Now, there's some cracks, there's some extended uh, indicators that we have that are showing that maybe we're getting overbought in this situation. But you take everything, you look at just the chart, and yeah, it's looking quite positive right now. One thing to keep an eye on, though, is we were really falling with the 10-year yield. We tested 4% a couple of times intraday, and now it looks like the 10-year yield's starting to go back up. And if that keeps going up, that could cause some problems for stocks. And the dollar, which is in a downtrend, both on the daily side and you'll see here on the weekly side, that's bounced up the last couple of days, but yeah, I mean, it's quite negative. It could be just a dead cat bounce or an overbought bounce, or excuse me, oversold bounce. that we're seeing there. But watch those things, the dollar and interest rates, if they still start going up, and the stock market may make note of that at some point, and that may cause some concerns. Now, the Fed did meet this past week and they cut rates a quarter of a percent. That was not a surprise. The market had pretty much said that's what should happen. It's what were they going to say? And now there was the initial gyration after Wednesday when they made their announcement, and we went up, then we went down, and we ended up pretty much going nowhere. It was like a roller coaster. You get on, you get off in the same spot, but the ride in between can be pretty wild. And then we did see positive follow through both on Thursday and on Friday. Not so much because of what the Fed just did, but the anticipation that the Fed's going to cut rates again in October and then possibly again in December. And the market likes that because the economy is not really falling apart. So the context is that the Fed is cutting rates just to tweak up the economy a little bit there. And there was some Fed speak that I'll go through and talk about as well. As far as our trend, we are positive, but we're still not trending on the weekly chart. We are trending on the daily side, both in the short and intermediate term, and the trend is positive. We are positive on the weekly side with the green line above the red line, but we're still not seeing the ADX really turning up yet. So, going over the weekly stats here, the Dow was up 1%. It set an all-time high. The NASDAQ, a series of all-time highs, up 2.2%. The S&P was up 1.2%, and small caps, as I said, they were up over 2%. And that's boding better for the risk areas of the market. When people, you have a big portfolio or you're a money manager, what have you, and it's like, okay, we've got the Magnificent Seven, we've got a good balance, and those stocks are doing well. Well, let's take on a little bit more risk and try out some of these smaller companies and see how they do and see if that has any kind of an impact. And so they've been improving. A long ways to go to start outperforming the S&P, but they have been improving. All right, so here are some bullet points. We had an up week driven by clarity, as clear as you can get. It's like as clear as mud when it comes to pretty much anything the government is involved in. But the market feels a little more defined as far as monetary policy that they can run with. And they did cut rates, and we're at the 4% to 4.25%, leaving the markets focused on updated guidance for further easing. That's, again, what the market's looking at is not what they did on Wednesday, but where do we go from here kind of a thing. And there was some dissension. They're split. The folks that are on the FOMC, they're split on the pace of additional cuts this year. 9 people that are on the FOMC, and some of these are voters and some of them are not, and they rotate around. 9 projected 1 more, 2 forecasted 2 rate cuts, and 1 anticipates no rate cuts. So sector performance, and this is healthy for the market. We're seeing growth outperforming value in the bigger picture. We keep an eye on this day to day, and we see subtle little changes when the market appears to be getting more defensive. And then we have a couple of good days and we shift back to more of an offensive type of posture with the market. So communication, the big growth area, was up 3.4%. Tech was up over 2%. Google and Apple doing well in those areas. And discretionary. These are the 3 big areas that we want to see doing well when the market is more positive. And even discretionary was up 1.5%. Where you had the more defensive areas, specifically staples and real estate, they ended up being down on the week. And so that helps our growth to value ratios. It shows that the market is still more offensive rather than defensive. And economic data was mixed. It really was pretty good overall. It's what the market liked. Retail sales came in pretty strong, much stronger than expected. And again, that's a huge part of the U.S. economy. So with that doing well, it means the economy is doing pretty good. Industrial production was up as well. But then we're still having some problems in the housing area. Housing starts and building permits declined. And that's more forward looking. That's about as close as we can get as to what's going to happen in the future when it comes to the housing market. And that's a little bit of a concern. And then what really helped things on Thursday is we saw a drop in initial jobless claims. It really spiked up a week ago. And we're like, okay, is this really starting to show us some problems? Well, it kicked back down into a lower range this past week. And then this is more regional. The Philadelphia Fed Index, it was a lot stronger. It came in at 23.2. So you take the week together, it saw record highs, not only for the S&P, but across multiple indexes, large caps and small caps, with mega caps doing the best, and optimism about further Fed easing. And then the small caps, as measured here by the Russell 2000, it highlighted continued risk appetite because small stocks are considered to be risky. You can buy a small cap stock maybe for, I don't know, $10, $15 a share, and with the hope of maybe going to 25, 30, 50, 100. And then that stock might eventually become a mid cap stock and then eventually a large cap stock. So that's kind of the hope there. While the macro environment, looking at the whole economy, it provided context for the Fed's guidance and the pace for future the pace of future rate adjustments there. And the market's leaning more towards more cuts. All right, just want to look at this. I show this every week here. We are still down in this lower area as far as inflation is concerned. We're not really dropping down to that 2% level like the Fed wants. Now, we're going to get another read on that. Coming up in Friday's session will be the personal income and spending. And then the big report that the Fed relies on is the core PCE. That's the big inflation component there. We'll see how that's doing. Now, this chart looks at CPI, which we just had recently here, and that's still looking okay from the market perspective. But just keep in mind that things can and do change. The way they are now doesn't mean they're always going to stay that way. It doesn't mean they're going to fall apart like we did back in the mid to late 70s and see inflation just go through the roof. But it's not going to stay the way it is now. It might continue to go sideways. It might continue to fall. We just want to be aware of these things, keeping them in the back of our mind at all times. And this is the 10-year yield at 4.14%. We did get on an intraday basis down below that 4% level, but now we're starting to go back up. So we want to keep an eye on that. And this is when it bites more into corporate profits. So this wasn't updated this past week. This only updates when we get the employment report. We're a little bit concerned about this blue line going up here. These are quite long-term unemployed folks. We want to see, we have to wait now until the October report for this to be updated. And also, this is updated when the employment report comes out as well. It's kind of leveling off, but it's still looking good for those that are usually working full time. Then there are some posts here from FactSet. It says there's a 32% decline in the number of earnings calls citing uncertainty. So they seem a little more certain now. I'm not sure if they're certain good or certain bad, but they're less uncertain than they were before. And okay, so that just makes it easier for a lot of these companies to make decisions instead of the wait and see mode. And then the lowest number of earnings calls that cite inflation, it's really been dropping off here, both with this chart that you see here, and then we're looking at the overall pattern of that also declining. And then where are analysts the most optimistic when we're looking into the fourth quarter? Now, we're in the third quarter right now. That will end at the end of September. And then once we get into October, November, and December, that'll be the fourth quarter. So looking at what FactSet came up with here, there are 12,351 ratings on stocks in the S&P 500. That doesn't include all the stocks in the other indexes that maybe they're not even in an index. Of these ratings, 55.8% are buy ratings, 38.9% are hold ratings, and 5.3% are sell ratings. I don't do things based on this, but a lot of people do because there's a lot of manipulation here. If you're an analyst for a company and you come in and give them a sell rating, do you think they're going to respond to your emails? Do you think they're going to welcome you and give you a tour of the company and tell you all the little things going on there? Probably not. So there's some pressure in all of that. And so a lot of these folks that come up with these ratings, it's like, okay, how realistic are they? All right, that's just kind of where I come out on that. All right, here's the intraday chart. We go back to Monday, pretty slow here, both Monday and Tuesday, just kind of drifting. And then we did decline here on Wednesday. This is before the announcement. Then you see all the gyration. We shot up, we shot down, and we pretty much ended right where we started when the day was over there. And then we had some more economic data coming out, and that took us higher here. And we were able to hold on to those gains. We closed well off of the high, but it was still an up day when you account for the gap. And then this was more positive on Friday, but it was options expiration. We came down, we tested the unchanged level in the daily pivot, and then saw some healthy buying going into the close. And that has seen as a positive thing. So for the week, all the sectors ended up, excuse me, all the indexes being positive, with the mid caps trailing a little bit, but they were positive and they're not at their all-time highs. They're still kind of going sideways here. But we saw the NASDAQ 100, the NASDAQ, and small caps. We don't, haven't seen this black box over in this area for quite some time now, but it is improving. Now, the percentages that you see here are a little bit different. This is not Friday to Friday. This is just Monday through Friday. And I purposely do that just to see how were things contained within the 5 trading days that we just finished. And now we have all indexes year to date looking positive. We're up 3.4% with the small caps. NASDAQ is up over 17. NASDAQ 100 and NASDAQ are up over 17% now. The S&P is up 13 and a third percent. But this is looking pretty good. And then looking at the sectors, we did have an up week here, so I sort this according to what was up the most. And the three biggest areas are what you want to see: tech, communication, discretionary. When they're leading the pack, that's positive for the market. And then near the bottom end, we have staples, real estate, healthcare. Those areas ended up being down. Those are defensive areas. Then looking at the scooter score, tech coming in first place at 91.8. That's a good score. When we get up into the high 80s, low 90s, that's looking pretty good from a technical analysis perspective. We're also getting a pretty high reading with communication at 89.2 and still pretty good discretionary with 83. But it's been coming on. It was underperforming for a lot of 2025, and now it seems to be one of the stronger areas, similar to what we saw a year ago going into the end of 2024. Are we going to see a similar continuation of that in 2025? Then the weaker areas, energy, staples, healthcare, real estate, these are all down into the single digits from a technical analysis score point. So looking at just the 5 trading days, we had tech up the most, and we like that financials are doing better, but they're still underperforming the S&P. But they have been doing that since last spring, and they did it all through the summer. But you look at financials by themselves, the chart is it's not really breaking out right now, but it's certainly in an uptrend. And then we have a lot of the other areas which are still underperforming here. Then going back to the beginning of the year, communication, tech, those are the two stronger areas. Now, discretionary is still negative year to date, but it is improving. And then we have healthcare, staples, real estate, and energy. These tend to be the more defensive areas. Then looking at the market carpet for the whole week, where we had Apple, it was up pretty solid there, and you had both Googles here. That's really what helped the communication sector and tech to do well. And also, you had the NASDAQ 100 doing well. You had the S&P 500 doing well, mainly because of these stocks. Oracle is seeing more advancing here. And then discretionary, both Amazon and Tesla had pretty good weeks, especially with Tesla. And then a lot of the red that you see down here are the more defensive areas. So looking at the relative rotation graph, nothing's really looking all that strong now. We're actually coming down a little bit. Now, this goes back over the last year, so it's longer term. It's not a week, it's not a month. This goes back a year ago. So tech XLK, that is not coming on really strong yet, but we are seeing an improvement with discretionary and communication. Those are stronger areas right now. And so we have communication, discretionary, those are looking better. Tech, which is turning more neutral, and then we still have other areas that are possibly maneuvering to turn more positive, but still are looking negative overall there. Looking at the indexes, we still have the S&P kind of camped out right around the midpoint here. We're seeing a bit of an improvement with the S&P 100, still a bit of a trailing off, but a possible reversal with the NASDAQ 100. Small caps are improving, mid caps are improving. We're still not seeing longer term improvement with the transports and still more weakness here with the utilities. So the big stocks, S&P 100, NASDAQ 100, that's more neutral. And then with the small caps and mid caps showing some improvement. Sentiment, and this is what I'm talking about here. Now, this is just the raw score after Friday, coming in at 62. Where we get some more context is by looking at this more historical reading where we are going up, so we're positive. And so we go with that. But if we get up around the 70, 75 level, that's where we start to get exuberant. There's not an actual number there. It's just more of an area that we follow. This suggests that we might still have more room to run to the upside based on a sentiment perspective. And then the active asset managers not looking totally exuberant right now. They're not above this red line, actually ticked down a little bit in the latest reading, coming down to 84.76, but still a healthy reading. Still looking good with the VIX. We went up a little bit here with the line chart and the bar chart, but you can see we've been setting a series of lower highs and lower lows when we look at the bar chart. So fears, for the most part, still coming out of the market. We want to keep an eye on the seasonality of the VIX. It hasn't happened. We've been watching this going back to August, and we haven't really seen an increase in the VIX because stocks have been going up. Now, if we start to go down with stocks, we will see the VIX start to pick up. Looking very good here. Still declining, setting a new low with this ratio, which is actually very positive. This just means cash is underperforming the tech sector. Getting a pretty bullish reading right now from the right X bear bull ratio. And this is what I'm talking about with individual investors. Still, there was an improvement from the previous week, but we're still net bearish overall, still coming in with a minus score here. And these folks, which are you and I, we're individual investors, but this is an organization that you can belong to. When they get up here to this pink line, like 30, even above 20 sometimes, but especially if we get up to 40, they're like, okay, we need to chase this market to try to not be left out. Well, we're still far away from that. And so it is negative overall. You have folks that are real suspicious of this upward move, but from a sentiment perspective, we could still go up before this gets to an extreme positive reading. Still not seeing very much fear here with the Ulster Index, still getting a low reading with the spread between risky and not as risky bonds. This is still going up. That means fear is coming out of the bond market. Still going down with the VIX and the 3-month average of the VIX here, and that's positive in this context. With this going down as the S&P has been going up, and then we're still declining longer term with the equity put call ratio, and that's positive in this context as well. And just kind of humming along here, not any real big changes with the economy. This is a weekly chart, and still below the black line with the Chicago National Financial Conditions Index, still coming in above 3% with the GDP Now forecast, and still looking positive here. This is also the GDP Now forecast, but just represented in a different way. This is the New York Fed. They're still coming in up over 2%. They're actually a little less positive than the folks in Atlanta right now. And this was updated after the employment report came out, where we're still going down overall. Even though we came down to a reading of 0.1, we went back up to 0.13. If we get up to 0.5, that's when we start to be concerned with this chart, and we're far away from that. Also, we want to keep an eye on this. This isn't updated all that often either if we get above this black line, but still suggesting that the probability of a recession is low. And this will be updated at the end of September again. We'll see if we see an upward move or a downward move with the Brave Butters Kelly leading index. Then inflation, just kind of not really changing all that much. Now, this will change as we go through the next week with the core PCE inflation report coming out. And now we're done with September as far as the Fed. So now we're looking ahead to October 29th. And there's almost a 92% chance that they're going to cut rates another 25 basis points. We're at 4 to 4.25 now. They think that we'll be at 3.75 to 4 after the meeting at the end of October. And the market's becoming more convinced of that right now. This is the dark blue. That's where we're at right now. Then you look a day ago, a week ago, and a month ago, and the market's becoming more convinced that's what's going to happen. And now we start looking out to the December 10th meeting, and there's a 78.6% chance that there'll be another rate cut when they get done with that meeting. But this is still a bit off into the future, and we're seeing a little bit more conviction that that would actually happen. And looking at the Fed balance sheet, still continuing to decline for the most part, but still going up when we look at the year-over-year change. Coming down to this black line here with the overnight reverse repurchase agreements, we'll see if we stay above the black line or if we end up dropping below that. So looking at the breadth, now this is a little bit of a negative divergence here. We were up, setting an all-time high with the S&P, but we were down for the week with the advanced decline line based on price. But we are looking pretty healthy based on volume. And we're seeing that on the daily side. We're seeing volume holding up better than price right now, and that could end up being positive when we see volume doing better. And then it's like price has to catch up with what we see happening with volume. And not really seeing much of a change here. We're still seeing more green than red, a little bit of an expansion of the new highs, a little bit of expansion of the new lows. So we're still going down with the 4-week moving average, and we're pretty much flat with the 10-week moving average. We did decline here with the advanced decline ratio, even though it was an up week, but we're still above zero. And then as far as our trend, we're trying to turn back up, but we haven't come across the moving average again yet, and we're still below 20. So this is a weakening, non-trending environment. But it's positive because the green line is above the red line. And we're positive here with the Arun. More buyers than sellers currently, so the oscillator is quite positive. And the mass index, that was triggered a long time ago, and we're not really getting a recent signal now. So we look at the daily chart here, where we're just a little bit underneath these daily pivot points. Is that going to produce some kind of overhead resistance? We're looking pretty good as far as the bar pattern here, with, for the most part, higher highs and higher lows. And setting all-time highs here. We're above both moving averages. The moving averages are going up. And we saw, for the most part, there was a couple of days we were below average with volume, but the huge spike that we saw in Friday's session. Then we look at a 50-week moving average here. Red line going up, black line going up, and the black line is above the red line. That is positive. Then we use moving average crossovers here. The blue line's above the red line and prices above both. That is positive. And now I'm going to start calling this support. I had been referring to this R1 pivot point as resistance, even when we got above it. Now we've been above it for a couple of weeks, and we're look to be slicing through that pretty good when we look at the weekly bar. So if we do start to fall, this is one area, 64.68. We'll be watching that as some kind of a support level. If we fall through that and we see more of a decline, then that would be more negative. This might end up holding. The longer we stay above this, if we do come back down to this level, the more likely it is to act as support. Also, kind of breaking out of the upper end of the trend channel, going back to 2009, we got overextended here back in 2020 and into 2021. And then we saw some bad things after that. Not saying that's what's going to happen this time, but this is starting to look a bit overextended. Now we look at the smart money indicator here. We are positive. We're above an advancing moving average going up, and the boom indicators going up here. We could be getting a little extended. This is above this red line here, meaning more in the short term that it's looking overextended. And we're still going up with the Chaikin money flow. We're leveling off with the histogram, but the red line is still going up. Now, this is also a possible concern. We're actually negative on the daily side. Even after Friday's advance, the Chaikin oscillator is still going down. But we're well above this red line. We're going up. This is a pretty high reading here. Again, when we did hit this level and saw prices decline after that, it didn't mean the end of the world, but we want to respect this. In fact, here back in 2024, it just kind of kept going here. We saw a little bit of a pullback later on, but this is looking quite overextended right now. And the vortex, it had been looking overextended. It's still positive with the green line above the red line. And we're still below zero with the McClellan oscillator. That's slightly negative longer term. We're still negative based on price on the daily side. And we are declining based on price. And we're actually ticking up based on volume. This is also showing us volume is outperforming price right now, which could end up being positive. But we have to follow price. It's the ultimate indicator. Volume may be just screaming all kinds of positive things, but until we see it based on price, we kind of have to go with what price is doing. And we're actually dropping down a little bit below zero here with the swing trading oscillator based on price. We're negative now. We are declining, but still above zero based on volume. So volume's holding up a little bit better. And we're kind of going sideways right now with the bullish percent index. Not seeing a lot of weakness, but not seeing an overall amount of strength. It did improve as the week unfolded, and it's still leaning positive on the daily side, where we're seeing a lot of choppiness right now here on the weekly side. And we are declining with the PMO. It's going up when you look at it by itself, but you break it out based on price and volume. And we're also not looking all that good on the daily side. To see this going up and to see these going down, that's a negative divergence. So we're below 50 with the buy signals. We're declining, the PMOs that are rising. We're below 50 and declining with the buy signals and trailing off a little bit with the PMOs that are above zero. And we spent a couple of days outside of the upper Bollinger Band on the daily chart. We never got there here on the weekly chart. This is still looking quite positive. We're above the midpoint, and the midpoint is going up. And we're rolling over a bit here, but we've been seeing this for a few weeks with the slope oscillator, but we're still going up with the other short-term oscillator, the TSI. And then we have three intermediate term oscillators, which are going up, and the two long-term oscillators are also advancing. But we turned negative here back in August with the copy curve. Hasn't meant anything to this point, but it's still continuing to go down. And we're still looking positive with the force index. We're still above 50 with the money flow, where we're getting above this 80 level on the daily side. But then we're showing longer term momentum here with the Stochk RSI. Still looking pretty solid there. The Williams percent R, and we're still seeing this on the daily charts as well. And we're just a little bit extreme here with the RSI longer term. We're getting above that 70 level. We're also seeing that in the short and intermediate side, especially the short term with I use an RSI based on 9 periods there. We're looking extreme where the 14-day is solid but hasn't quite gone extreme yet. And here we are extreme with the ultimate oscillator. We had an up week here, so that's the 1 week rate of change. And we're going back up a little bit above this red line here with the 50-week rate of change. And the daily special K chart is positive, and right here, the weekly special K chart is positive. I haven't adjusted these yet because we haven't really topped out, at least for the time being here. And so the trend is still looking good, though. The Heiken Ashi is quite positive, as is the Kegi chart, Renko chart, three-line break chart. And we drew in another X here on the weekly chart that's a point and figure. We had a double top breakout that was generated back in June, and we were able to add to that with the new highs that were set. And still looking fairly positive here on the ease of movement 14 week. We're still just kind of hovering barely above zero on the daily side. And longer term, with the momentum, we're looking positive there. We're showing some improvement intermediate term as well as short term. And we're looking positive again here with the Elder's Impulse system for the S&P. It went from neutral back to green, and we are positive with the parabolic SAR. We're positive on the daily side as well. Positive on all time frames. These are daily time frames here with all the different indexes. The dollar is still negative on all time frames, and we've actually switched over to long-term negative with bonds based on price. So we're setting new highs here with the S&P. Now, this is the SML. This is the S&P 600. This is not the Russell 2000. And it's still lagging behind, and the mid caps are still lagging behind as well. When I created this chart, I wanted to have all S&P based indexes, the S&P 500, the S&P 400, and the S&P 600. That's why I have it out this way. Just it's more, I like to think of it more as being like-minded in the way they're calculated. Okay, so the Dow setting a high in an uptrend here. NASDAQ setting a high on the weekly chart. NASDAQ 100 setting an all-time high. Mid caps not back to an all-time high. This version of the small caps not back to an all-time high. NYSE is setting all-time highs. All stocks doing pretty good there. U.S. and international stocks. The FANG index setting all-time highs. ARC improving here. Actually was able to bounce up off of its 13-week moving average. And then we look at the banks. Seeing some improvement there. We're finally breaking out a little bit with the KBW bank index, but we are starting to get above 70 with the RSI. However, shorter term, the momentum is positive. Seasonally, September is bad with the last 2 weeks being bad, but it hasn't even begun to happen yet. We'll see if it starts to develop in the upcoming week. We're only up 40% of the time over the last 5 years with a negative return of 2.8%. And then this is Dow theory here, where we're seeing a non-confirmation, where we're setting a new all-time high with the Dow. That's not being confirmed by the transports. And the perma bears are going to pick up on this and scream that for a 50% decline or something. But the transports have been lagging for quite a while now. And we are not setting an all-time high here with the utilities as well. And then some broad market measures still kind of just trailing along, going sideways right now with the CRB index. And oil is getting a little bit further down into the lower range of the 60s right now. But the daily chart of the dollar is down. Here we have the weekly chart is negative as well. Copper still hanging in there to an uptrend. That's holding up fairly well, but we're breaking out with gold. We're also breaking out with silver. And then we look at bonds based on price. They are looking pretty good here. Longer term, the stock to bond ratio shows stocks outperforming. And we were seeing the rates coming down here, but the last few days they started to bounce back up. We just want to keep an eye on that. We also are keeping an eye on this red line here, which is Japan. They're going up again with their 10-year yield. If that continues to go up, is that going to create a problem similar to what we saw a year ago? And then our relative studies here, looking at the intermarket analysis, we have gold. It's up almost 41% year to date. Then stocks are in second place. Then we have commodities and the price of bonds kind of more or less even with each other. Energy's dropped back down to negative, and the dollar is the weakest performing asset in 2025. But we look at some different ratios here. The NASDAQ 100 to S&P shows the NASDAQ 100 outperforming longer term, and that's positive, even though they're both setting all-time highs. The S&P 100 is outperforming the S&P 500. Growth is outperforming value. Gold, it's got back above this moving average here with the ratio, but longer term, it's got a little bit more to do to start outpacing stocks again. But it is really going up when we compare it to the dollar. This ratio continues to go up here. This also shows how in the longer term weekly chart, bonds are underperforming stocks. Even though bonds are doing okay, stocks are doing even better. Discretionary to staples. This is an area that we have been seeing improve, and this is more positive if it can continue to improve. Low volatility to SPY ratio. This going down is more positive. That means the market is becoming less defensive. And we're still seeing energy underperforming tech. We see little bounces up here and there, but overall, it's continuing its decline. And small caps, even though they're doing okay, this is the IWM, which is the ETF for the Russell 2000. And it has a lot of damage to repair to start outperforming the tech sector because tech is doing good. Even though small caps did good, tech did even better. So this ratio actually declined. Then longer term, not really seeing much in the way of the NYSE breadth thrust. We're still working off of this signal that was generated back in April, and that's good for, I believe it's a year that goes out. There's differing opinions on that. It might be 3 months or 6 months, but this is still the signal that we're working off of for right now, and that was generated way back last spring when we came up out of the lows. We're still at a -6 with the Zohorchak. We would like to see this improve, get maybe up to 0, possibly go positive. It hasn't changed over the last week. And we're getting a little bit further above this trend line, going back to 2009 with the NASDAQ 100. Not really seeing much of a change here with the 50-week new highs, new lows moving average here. We are positive. We're above 0, but if this was to continue to go back up, that would be more positive. And we are looking more positive with the new highs, new lows for the NYSE. This is actually going up and seeing a little bit more conviction with its 50-day moving average. This is looking good here. NASDAQ to Dow ratio, NASDAQ 100 to Dow ratio coming back well above this red line. The Qs to small caps still above this blue line here. And we're still dropping with the 3-month yield, which appears to be dropping because interest rates have been coming down, and that's more positive. Instead of a fall off the cliff, we're going into a great financial crisis like we saw back in 2007 into 2008. This is still looking good here with the cumulative new highs, new lows for the NASDAQ. Seasonality, though, again, we were waiting for this to happen in July, August. Didn't happen. Is it going to happen now that we're into the second half of September? This is the worst performing half a month of the year going back to 1950. Also, this shows where September has been negative. June to November ends up being not all that great here. And this hasn't been updated for a while, but this is the seasonality that we've been focusing on here that just hasn't materialized yet. This also shows going back to 1950 how the S&P has underperformed. So thank you. I hope you found this helpful. Have a really good weekend, and I will talk to you in the next video.